Good morning to all of you in Germany. Good afternoon to all the participants in India. On behalf of our embassy, a warm welcome to all of you to today's webinar, focusing on the key topic of transfer pricing. Our thanks also to Rödl partner, which is our knowledge partner for the missions for our embassy's Make in India Mittelstand program, for organizing this webinar today on this important topic and for sharing their expertise on how the transfer pricing regime in India functions and how companies could optimize their international tax strategy. I welcome the officers from the Central Board of Direct Taxes, Ministry of Finance, Ms. Ruchika Sharma and Mr. Dr. Vijay Patel, Undersecretaries in the Foreign Tax and Tax Research Division, for addressing this webinar today. A warm welcome also to all the attendees to this webinar. Friends, there are a whole range of reasons why India is one of the most important and interesting destinations today for foreign investments. The country is one of the few markets to be in a sweet spot from an economy perspective. The economy has increased in size from being 10th to 5th largest in the world in the past 9 years. And the growth momentum of our economy remains strong and is projected to grow about 7% in 22-23. India's goods and services exports, which are being a driving force behind the country's economic growth, is expected to cross $750 billion in this fiscal, despite the global economic challenges and uncertainties. Over the years, bilateral trade between India and Germany has been steadily increasing, and German companies have also discovered new businesses and investment opportunities in India, and so have Indian companies in Germany. Transfer pricing issues, hence, is an important consideration here. I invite German companies who are present at this webinar today to take advantage of our embassy's Make in India Mittelstand program. Our colleagues from Rödl partner will walk you through as to how we from the embassy could support you in your investment journey in India. The program is in a way India's red carpet for the German Mittelstand. Let me conclude here by wishing you all interesting discussions. Thank you. The floor is back to you, Tilman.
Yeah, thank you very much. Yeah, I do not want to stand long between you and our very interesting program today. As Mr. Vittel just said, there is a lot of profit to be earned, no business to be made in India, actually profit to be earned in India. Now the question is, where do we have to pay the taxes for the profit on the profit? And this is the topic of transfer pricing, and this is the topic of today's webinar. And I'm very happy that we have the opportunity to also listen to the Central Board of Direct Taxes, so the India Tax Administration, to their point of view. Because this is essentially the authority that you and we as advisors do face when doing transfer pricing planning, documentation, and sometimes also dispute resolution. And in addition, actually, we will also present introductory slide or some introductory slides on transfer pricing for those of you who are not transfer pricing experts so far and would want to understand some basic facts and background of the transfer pricing. Yeah, as Mr. Vittel just said, Rödl Partner is the knowledge partner for the Make in India Mittelstand program, and I'm Tilman Ruppert, responsible for the India Tax Advisory Services of Rödl Partner in Nuremberg, and I will take you through the session today. After the presentations that I've just mentioned, actually, there is then also a part which I want to moderate. It is a part with questions actually raised, especially through the CBDT, and where discussion can be, where we hope that there will be a fruitful discussion and interesting discussion. Let me briefly explain the technical side of the program now before we continue the session. So the following functions in the GoToWebinar tool you're having here are available to you. In the upper right corner of your screen, you will find the control panel. Here we can adjust the audio settings and choose, for example, between your headset or the computer audio. Please note that as a participant, you are muted by default. A bit further down the dashboard, you will find the question panel. We will request the attendees to please post their questions in the question section down there, and we will take up the questions in the last leg of the webinar during the Q&A session, which follows the discussion that I just mentioned. The presentation will be shared with you after the webinar. And one remark, the webinar will be recorded. This is for you maybe important to know. The webinar itself will take an hour, as I said, made up of the various participations of the CBDT, of my colleague, and of the discussion then, and the Q&A. Well, important for you to know is actually who is speaking today. So please allow me to briefly introduce today's speakers. First, there's Dr. Vijit Patel. He is an officer of the Indian Revenue Services and has worked in various positions in the India tax administration in his career. In his previous assignment with the government of India, he has performed audits of multinational enterprises as well as domestic corporates and has represented the India tax administration in international taxation matters in the Authority of Advanced Ruling. Presently, he is posted as Under-Secretary in the Foreign Tax and Tax Research Division of the Central Board of Direct Taxes of the Ministry of Finance. Here he is actually responsible for handling transfer pricing matters for jurisdictions in North America and Europe. Further, for those who know maybe the OECD BEPS initiative, Base Erosion and Profit Shifting, he is an Indian delegate to the Working Parties 6 and 10 of this initiative and the country-by-country reporting group. He also is delegate to the Mutual Agreement Procedure Focus Group of the Forum on Tax Administration that has been tasked with identifying various country practices in relation to benchmarking of international transactions of multinational groups. Further, he is the member secretary of the Task Force for Statistical Analysis of Uncontrolled Transaction and has been involved in performing statistical analysis on economic data, specifically in relation to transfer pricing. He has also been involved in the BEPS initiative Amount B work since its inception. And he has been representing India in the meetings of the corresponding joint forum. So perfect speaker for today, I would say. And he is joined by an also perfect speaker, Ms. Ruchika Sharma, his colleague. She is an Indian Revenue Service officer with nearly 9 years of experience of working in various subject areas with the India tax administration. In the area of transfer pricing, she has worked as a transfer pricing officer. That would be the one that the Indian company may have to face when there are questions regarding the transfer pricing. And as a part of that team, she's handling the unilateral advanced pricing agreements before joining her current role as an undersecretary in the India Competent Authorities Office. She currently handles transfer pricing related mutual agreement procedure cases and bilateral advanced pricing agreement cases with countries across Europe and with the United States. She's also the Indian delegate to the OECD Working Party 6 and has been engaged with handling the ongoing work on Amount B by representing India in the meetings of the corresponding joint forum. So also very great to have you, Ms. Sharma. And we also will, I understand, especially hear from you about the APAs, about the settlement procedures, about the advanced pricing agreements. And then we have Mr. Pritamraj Jhala. He is my colleague. He is an Indian chartered accountant and a commerce graduate with more than 6 years of post-qualification experience in transfer pricing. He has, among other things, ample experience in providing advisory services to Europe's largest automotive group on the implementation of new business models, intra-group arrangements, etc. in India, in assisting the preparation of local documentation and master file related compliances for foreign subsidiaries operating in India and regarding tax litigation strategies when we face the officer and representation before the tax authorities on transfer pricing matters. Now, as I said, I won't make it too long. With no further delay, I would now like to hand over to my colleague Pritam, who will initiate today's webinar with a short introduction into transfer pricing. So over to you, Pritam, please.
Thanks, Dylan. Just give me a second. Thanks, Selman, for the warm introduction. Now coming to the agenda of the presentation, our idea was to keep it as short and simple as possible, but still it should provide a broad picture of how the Indian transfer pricing or TP regulations look or there are in existence in India. I'm sure that some of you are already aware about the transfer pricing concept in general and might have dealt with TP regulations in other countries. But for sake of other participants for whom the topic is new, it is important to start with discussion on the basics. So at first, we'll talk about the transfer pricing in general and relevance of that from Indian point of view. Then we'll broadly look at the TP compliance framework in India. Then I'll touch upon what are the broad steps that are performed to arrive at the arm's length price of a particular international transaction. Then at last, I'll briefly touch upon what are the alternate dispute resolution options available to a taxpayer in India. Now, as the topic of the presentation suggests, it is on transfer pricing, but it is important to understand that what actually it means and how it is relevant. So transfer price by its definition simply means that the price at which cross-border transactions are entered by the group companies of a M&E group or multinational group. So these transactions could be between parent with its subsidiaries or between co-subsidiaries having a common parent or a common ultimate parent entity. The transactions which generally group companies have will majorly fall in any of these four baskets. First could be sale, purchase, or transfer of tangible goods, like supply of raw material. There could be supply of components, supply of spare parts, or supply of finished good. Second is provision of services, which could be again in the nature of IT services or technical support service or management support or your R&D support or software development, etc. Third could be transfer or lease or use of intangible property between the group entities. Fourth would be the rest of the transactions like reimbursement of expenses, some financial arrangements which group companies would have with respect to loan and guarantees. Now, after looking at what TP means, it is important to understand what is the concern of tax authorities in general and why so much prominence is given to this topic. So as M&E Group will of course have presence in more than one country through its various group companies. Also, these entities are controlled by a common parent. So there can be a situation that transactions are structured in a way that there is a possibility of tax-based erosion of a particular country. Now, how that can happen? Just look at the picture on your left side. Here you can see that company is based out of India, and for our discussion, assume it's a manufacturing company, and company B is engaged in sales and marketing. It's located in Dubai. In this case, company A manufactures and sell the product to Dubai company, that is company B, at the sales price of 100 and end up making a profit of 20. Now the final selling price of this product by Dubai company to the end customer is 150, and this company is making a profit of 50 where there is no tax. Of course, like UAE has introduced taxation, but for our discussion, I have assumed that there is no tax. With this overall tax cost, if you look at from the group's point of view, is Indian rupees 6. Now look at the situation on your right hand side. Here, the price of the product by company A to company B, which is transferred, is based on the market forces, or you can call it as it's at arm's length, and it's not influenced. Now the sale price, of course, doesn't change. So sale price remains 150. Now the profit of Dubai company is reduced to that extent. What is evident here is that if transfer prices are influenced, it can lead to tax saving for the group and tax-based erosion for a particular country. Now to keep a check on this kind of transfer price manipulation, specific transfer pricing regulations were put in place by various countries, of course, including India. So the important principle in the transfer price legislation is that transactions should be at arm's length basis or at arm's length price, which basically means that there should be at fair value. And how you determine the arm's length price? It is by application of various transfer pricing methods, which are prescribed in the regulations. Now let's quickly see the evolution of transfer pricing in Indian context and some important timelines. So in 1961, the present day Income Tax Act of India was first introduced. In 1995, OECD came up with detailed transfer pricing guidelines for M&E groups. It was only in 2001 when the transfer prices were introduced in the Indian taxation and the detailed rules. Thereafter, post BPS project, India accepted the three-tiered documentation structure in 2018. So it's important, after looking at the timeline, it is important to keep in mind that transfer pricing legislation in India is in existence from last 2 decades. Still, it is considered as one of the most aggressive and developed, of course, in terms of implementation of TP rules. Now, what we are seeing in the slide is the broad procedure of how the compliances are done in India. So the first step for any taxpayer is to identify what are the associated enterprise of that particular taxpayer, or you can also call it as group entities of this entity. Thereafter, you have to see what are the kind of international transactions you have carried out with your group entities, and what is the exact nature of those transactions and value of such transactions. Then next, this information like details of your associated enterprises and international transactions are documented in your local transfer pricing file or transfer pricing documentation, how we call it. Along with that, you also document the functional analysis and details of transfer pricing methods which you applied, what kind of benchmarking data you have used, how you have determined the consumption price. So all that will form of this local file. Along with the TP study report, taxpayer is also required to file a certificate which you have to obtain from an accountant about the true and correctness of your transfer pricing documentation. There may be other compliances which may be applicable to you, like master file and country by country reporting. And if it's applicable, then you have to comply with that. Then next step could be if your case is selected for assessment, then a special officer, what we call as transfer pricing officer, does the transfer pricing assessment. And after the examination is over, as in assessment is over, they may propose a transfer pricing adjustment, or they will accept your transfer pricing documentation. If an adjustment has been proposed in your case, then of course you have an option to litigate the matter and present your case, present your arguments before the higher appellate authorities. So that is how the usual transfer pricing process is for compliances in India. Now, to avoid any litigation or how you can defend your case, there are various options available, which we'll have a look at the end of this presentation. In this slide, I have just tried to provide some timelines and monetary limits on whether a particular compliance is applicable to you or not. So if you'll see, the accountant report is required to be filed even if your transaction value is INR 1. Next, the transfer pricing study report or the local file is applicable, a detailed local file is applicable only in case when the value of your international transaction exceed INR 10 million. There are also monetary limits on the applicability of master file and CBCR compliances in India. It's important to also note that transfer pricing compliances are also applicable to non-resident in certain cases. But those cases will be when particular transactions give rise to taxable income in India for such non-resident. There are also timelines provided for along with the possible penal exposure if there is any kind of non-compliance. Okay, so till this part, it was more about theoretical discussion on the compliance framework in India. Now, if I have to take you through a practical case in a situation that you want to enter into India and the Indian market, in that case, how you will ensure that the transactions undertaken by Indian entity are on a arm's length basis. In this scenario, of course, there are various ways available to you how you can enter India. You can set up a manufacturing concern in India, or could have a distribution company, or you just want to have a service company in India. Now let's take the discussion ahead, assuming that you want to set up a manufacturing company in India. Like taking words from Mr. Shikumar, that India is the fastest growing economy, and of course it is aggressively promoting the Make in India campaign. Coupled with that, the income tax rate for new manufacturing companies in India has also been substantially reduced, and at present it's around 15% plus some surcharge. If you proceed with having a manufacturing company, first step, what you have to decide is what kind of functions you want this particular entity to perform. Based on this functional analysis, this particular company can be categorized as a licensed manufacturer or a contract manufacturer or a full-fledged manufacturer. Based on the classification of this particular manufacturing entity, its transfer pricing policies are required to be decided. There's a saying that more the risk, more the return. Of course, that same applies in transfer pricing principles. Assuming you decide that this Indian entity shall act as a contract manufacturer for you, then as per general transfer pricing guidelines, it is required that this entity is remunerated on a reasonable and routine arm's length profit for its contract manufacturing activity. So if there are any losses arising due to unutilized capacity, then they have to be borne by the parent or group entity which is acting as a principal in this arrangement. Now, when I'm talking about a reasonable arm's length profit, you might have a question as to how we can find that out. What is the arm's length profit required in India? For this purpose, there's a concept of benchmarking analysis that would come into picture, where essentially what we try to find out is what is the profit margin earned by comparable Indian companies who are engaged in similar kind of manufacturing activity and acting as a contract manufacturer for their principals. Now, take a case that you decide that your Indian entity shall act as a licensed manufacturer and not contract manufacturer. In that case, it will be important that what kind of know-how or IP is being provided to this group company, and what is the arm's length license fee royalty which you can expect from this Indian manufacturing entity. Again, for determining that, there are benchmarking studies which are undertaken where we can find out what is the existing license fee or royalty rates being charged by independent entities in similar circumstances and arrive at an arm's length license fee percentage. Like I said, there could be other India entry options like distribution, marketing, support service provider. And again, the transfer pricing policies that are required to be implemented in these cases will be different and may be required to be backed up by a benchmarking analysis. Now on to the last part of this presentation. It is more about the alternate dispute resolution mechanisms that are available with the taxpayer. What we mean by this option is that in a case if there is any dispute with the tax authority or you want to avoid any possible dispute, these options can be evaluated. In this category, the first mechanism is safe harbor rules. So the Indian regulations provide for a safe harbor mechanism where basically the government itself is saying that if you achieve a particular kind of operational profit, or if you decide your transfer price in a particular manner, then it will be assumed that your transactions are at arm's length. Some of the major transactions which are covered under safe harbor regulations are with respect to if an Indian entity is a service provider and is engaged in providing services for, let's say, software development or for IT enabled services, then the safe harbor rules provide that there should be a minimum operating profit of 17%, which is required to be earned by this particular Indian entity. There are also other category of transactions which are covered under safe harbor mechanism, but what you have to see is there are specific rules which are prescribed as to how you have to apply to the tax authority, and you have to see whether safe harbor can be implemented in your case. Other than safe harbor, there are other options like advanced pricing agreements, wherein taxpayer can agree about its transfer pricing methodology or transfer prices in advance with the tax authority. Another option is in case of tax dispute is to apply for mutual agreement procedure or the MAP proceedings. Again, there is a specific mechanism with which you can apply for these options. More on both AP and MAP will be taken up by our distinguished guest from CBDT, as they are the ones who are extensively involved in these proceedings from the Indian tax department side. At least we have also provided in this slide some statistics with respect to the API applications which were filed in India and the number of agreements which were signed. I'm not going specifically into the number of APA on year-on-year basis. However, what the picture shows is how APA program in India has been well received by the M&E groups who are present in India. Before I hand it over to Dr. Patel and Ms. Ruchika, just one word of caution from my side, that there is a lot more in TP regulations other than what is covered in this PPT. So what I have discussed also. So it's important that you take assistance of someone who has expertise in TP so that the implementation of your transfer pricing policies and your India entry will be a smoother way. That's it from my side. Now I'll hand it over to Ms. Ruchika for some introductory remarks. Thank you.
Thank you, Pritam. Thank you very much for guiding us briefly through the what transfer pricing means in India. And indeed, now over to the CBDT, and we are very keen on getting to know what they would like to share with us on the dispute resolution mechanism.
Hello, everyone. First of all, thanks to Pritam for that very useful and insightful presentation. I would just like to offer a roundup sort of remarks and do the first part and pass it on to my colleague Vijit. What I would like to talk about with all of you is that as we heard during the presentation by Mr. Pritam, transfer pricing laws have now been in existence in India for over 2 decades. And I think it would be fair to state that the Indian Tax Administration by now has a lot of experience in the area of transfer pricing, which is evidenced by the fact that our domestic law is fully aligned with the arm's length principle. We have a flourishing UAPA as well as a BAPA program, and we are also actively resolving TP disputes under MAP with various treaty partners. In the last 1 decade, the Indian Tax Department on the whole has shown a marked shift in orientation from what we can call a focus on enforcement to more of facilitating taxpayer compliance and providing taxpayer services. In the recent years, for example, we've seen in India that as less as only 0.25% of total returns are being picked up for scrutiny, and it can be presumed that the trend is similar for TP cases also. Further, I would like to assure you all that the TP cases which are picked up for scrutiny in India are done so based on objective, predefined risk assessment criteria. The process of TP audit which is followed in India is transparent and it adheres to principles of natural justice, which means that we don't use any secret comparables. We give the taxpayer enough opportunity to respond, and the tax administration gives show cause notices before proposing any sort of adjustment. Also, to smooth out variations in the comparable data that we use, the Indian law uses what we call a arm's length range concept. So it's not an average of a data set in a particular year. We use a range and it spans over multiple years, which ensures that the TP adjustments are sort of moderated by variations from year to year. The Indian legislation also has provision for a dispute resolution panel. What that panel does is that if a taxpayer faces a transfer pricing adjustment, they have the option of approaching 3-member panel, which comprises of senior tax officials, before the finalization of tax demand pertaining to transfer pricing adjustment. And what is notable is the fact that the DRP gives its decision within 9 months of taxpayer filing an appeal. So overall, I would say that the process of TP audits in India is designed in line with global best practices, and procedurally, it is non-adversarial in nature. And with these remarks, I would now like to hand over the floor to my colleague, Dr. Vijit, who will talk a bit about the APAs and MAP landscape in India.
Thanks, Ruchika. So I would like to talk a bit about the advanced pricing agreements and the mutual agreement procedure that was discussed in the last couple of slides. So in India, we have a full-fledged APA program since 2012, and as is with most of the jurisdictions, there are 2 broad categories of APA. Unilateral and bilateral APAs. The latter also include the multilateral APA subset. To talk briefly about the unilateral APAs, the main goal of the instrument is to provide tax certainty for the covered period. If we talk about the bilateral APAs, the main goal is to provide double taxation protection as they are derived from the tax treaties, along with providing tax certainty. Another differentiating factor between these two instruments is that the UAPA costs relatively less, as the compliance and fees related to them is in one jurisdictions, where for a bilateral and multilateral APAs they have to be followed in two jurisdictions. And in fact, that is one of the main reasons that small and medium enterprises usually prefer unilateral instruments, as they would achieve tax certainty at a very low cost. I would also like to highlight here that Indian APA program is a mature program, and as was stated in the presentation, we have signed numerous APAs over multiple years with multiple tax treaty partners as well as unilateral APAs with the taxpayers on issues and transactions that range across spectrums, from contract manufacturers to licensed entrepreneurs to service providers. Similarly, and as I said, in bilateral sphere also, we have entered into advanced pricing agreements on various transactions. And related to advanced pricing agreement, another aspect which I'd like to highlight is that if a taxpayer enters into an advanced pricing agreement and would like to renew that agreement, we process those renewals relatively faster. So it's, if I can say, it's like the first advanced pricing agreement would be a detailed fact-finding exercise, and subsequent to that, if the facts of the applicant remains the same, then we would speed up the process, and that is something which is published in our APA FAQ also. Now, coming to the second dispute resolution mechanism, which is MAP. Similar to APAs, we have active relationship with most treaty partners and resolved numerous MAPs, which is a fact has been stated in the OECD published statistics. One noteworthy aspect which I like to highlight about our MAPs is that unlike some jurisdictions, most of our MAP results in complete elimination of double taxation. So that is something which both the CAs in India, the Indian CA and the foreign CAs, when they meet, they take particular interest in eliminating the complete double taxation. So I think I'll stop here. I'll give back to the moderators to take forward the webinar.
Thank you very much for taking us briefly through the work you're concentrating on. The advanced pricing agreements are indeed a mechanism which shall avoid disputes, but however, which as per our experience so far, is not yet so often chosen. But we also would really advertise to explore this kind of mechanism more often, especially at least an unilateral advanced pricing agreement, as you mentioned, because it's less time and costs are involved, and the, how did you call it, the legal certainty is given, no? And this is indeed a value by itself. A value by itself. Now, having a look at the transfer pricing landscape as such, in India, and starting now the discussion, I would want to, where we want to actually in the discussion get an impression on how the CPTT deals with certain cases. We'll talk about contract manufacturing a bit, but also want to understand about how the CPTT takes into account the OECD principles and so on. Now, because for our distinguished guests, I think, an audience, I think it is important to understand, is really India a country of bureaucracy and high taxes and aggressive tax office. And I think already now, with your very kind introduction, I think we have been able to reduce some of the fears, actually take away some of the fears. And I feel that the following discussion that we would be having now briefly is also able to make the audience understand that India is a fair country, actually, when it comes to taxation. It's not an easy country. It's nothing with where you can sail through so easily, but it is fair and a trusted location, actually, when it comes about taxation transfer pricing. So in this regard, my first question actually would be, like, transfer pricing always has cross-border effects, obviously, no? In two taxpayers involved, one in Germany maybe and one in India. Now, you mentioned already diverging opinions maybe of the tax office, which may result in double taxation, therefore the bilateral APA you have mentioned. Now, the OECD has also tried to establish a set of guidelines for reducing the effects of such diverging views, with the aim actually to reduce the incidence of double taxation and with the aim to provide predictability and clarity. Now, can you tell us maybe, Ms. Sharma, Dr. Patel, what role does the OECD transfer pricing guidelines play in India?
I'll take this question on behalf of CBDT and would also like to state that there's no need to fear the Indian tax administration. I think what's most important is fairness of process and clarity in procedures. And once that is there, a taxpayer who's fairly declaring prices has absolutely nothing to fear. On your specific question, I would like to say that Indian TP laws are built around the arm's length principle, which is the cornerstone of transfer pricing. So India, as you know, is not an OECD member country, and therefore the OECD TP guidelines are not binding on us. However, Indian TP laws are very much in harmony with the OECD transfer pricing guidelines, as well as the UN practical manual on transfer pricing. And references are always made to such global guidelines by both taxpayers and tax administrations while carrying out the transfer pricing work in India.
Pritam, is this also what we are witnessing in our advisory practice? Is there the interpretation of the OECD guidelines, the adherence to them?
Gentlemen, so in our experience, of course, like what Ms. Sharma said, it is being followed. So whenever there are any disputes or if you want to justify certain things, then we take reference of OECD, and that is something which is well received by the officers. Unless there is something which is almost different being provided in TP regulation itself. So in case of, let's say, tested party, there is nothing much which is there in Indian law. So how you describe it, how you take a stand, what is tested party, So that is one thing where again OECD guidelines come into picture. And what we see generally is if there is any thing missing in Indian regulations as such, even appellate authorities are looking at what the guidelines are providing, something which Ms. Sharma said.
I think I remember a decision of the Supreme Court in 2021 in the matter of the different subject taxation of software royalties on software, where the Supreme Court has upheld that the OECD commentary to the OECD Model Convention, the Doppelbesteuerungsabkommen, is also very relevant and shall be utilized also in India, also by at least taken into account by the tax office, though it's not law in India. Yeah, Dr. Patel, you are nodding. Feel the same?
No, I think I'll echo the views shared by Ruchika, but I understand the case you're referring to, and in India, I like to say that taxation jurisprudence is quite developed, and as is with other countries, courts refer to OECD transfer pricing guidelines and the UN transfer pricing manual, and so does our officers refer to them while you can say complying with the Indian TP laws.
Okay, then thank you. This actually means it's a good news, no, for the taxpayer, for the German investors, because OECD guidelines, their tax advisor, they themselves, the in-house tax department, they know from other countries. So India is not so much special here, no, when it comes about the interpretation. Now, another question maybe. We are as Rödl partner often advising German Mittelstand companies, and also the program we are now working for with the embassy is the Invest in India, Make in India Mittelstand program. So SME, there's a wider range obviously, but SME investing into India program. Now, German Mittelstand investors typically just want to make, let me call it, good business in India. No? They know that any conflict with you, with the Indian tax office, will just result in disputes and also high costs for representing them. That's, for example, Pritam, and before the tax authorities. So therefore, already amount bias, actually, any tax savings from any aggressive structuring would not justify for them such taking such risks and costs. Now, are you able, or does your law allow to decide a bit, to distinguish a bit between the big players, who may want to erode the profit base and shift the profits, or erode the tax base and shift the profits? Or are your colleagues at the transfer pricing office able to take this into account somewhere in the when facing the German investor, the German invested company, Mittelstand invested company, that probably they would not want to avoid taxes in India? Is there some relief?
Yeah, I like to come in and answer for that. So during our audit process, I would say that we do not distinguish between small, medium, and large taxpayers. Further, if I say that even the existing global guidelines on transfer pricing do not prescribe such distinction while checking conformity with the arm's length principle. However, I would like to say that we can presume that small and middle businesses do not have very complex transactions or business structures, which probably large MNEs would enter into. Indeed. And therefore, under the APA process, Indian tax office will most likely have an experience of dealing in similar transactions or structures, which may in turn, in my practice of seeing so many unilateral APAs, will hasten the process or quicken the process of resolution of the APA, because they've already seen similar transactions, and it's not a very unique structure which they would be coming into. The only place which, in my personal experience, I can think where distinction is there between large and small taxpayers is the safe harbor regime, which Pritam mentioned in his presentations, where a monetary threshold is set in by the government of India for certain transactions. But as such, officially in a written letter, there is no such distinction. But procedurally and from a practical standpoint, and from a personal capacity and a personal experience, I may say that, of course, there will be difference.
Yeah, I mean, that would be also a bit on the wish list of the German investor, no? That really, I mean, they invest in India for making good business and not for saving taxes. No? And by the way, the tax rate also is quite similar between India and Germany, meanwhile, no? The CIT rate. All right, let's have a look at the contract manufacturing. Actually, let's go a bit into a case structure, let me call it. Often German investors actually set up an Indian, I try to describe the case, I hope everybody understands it. Often German investors set up an Indian subsidiary for manufacturing for the Indian market. So the foreign entity, let us call him the principal, provides the technology to the Indian manufacturer for the manufacturing process. Now, ideally, the Indian manufacturer would manufacture the goods and sell the goods back to his German principal, the related party, the investor. No? The German principal would then resell the goods to his Indian unrelated customers, not because it's direction Indian market, sale to Indian market. We would, in such a situation, call the Indian manufacturer a contract manufacturer, Auftragsfertiger. Such a contract manufacturer is, as Pritam explained already in his presentation briefly, a routine entity which needs to earn a modest but stable profit. No losses usually, as Pritam explained. The residual profit, however, which can be, or the residual result, which can be a good profit or a loss, would be with the principal, especially with undercapacity, where the capacity is not utilized, as Pritam said. However, now, if, and this actually happens often or always, the Indian manufacturer sells and delivers the finished products directly to the Indian customers himself. Because actually it would not make sense to export the manufactured goods back to Germany. And now the residual profit obviously will then be with the Indian manufacturer. He will get the cash, the consideration for the sale from the Indian customers. Now, this may not actually fit to the functions, asset, and risk profile of the Indian company, which I think is still the one of a contract manufacturer. He still uses the technology of his principal, and he sells to customers which were pre-established, pre-identified by the German principal. Consequently, actually, the principal may think about charging a profit-linked royalty to the Indian manufacturer, so that the Indian manufacturer will, as we said, will earn a stable and modest profit, and the principal will be left with the residual profit or loss. do you actually see, would be really interesting to have your opinion here, do you see such a profit-based formula for royalties in India, and would you feel it is acceptable in general terms to CBDT?
So I'll take this question. Firstly, I think to set the context of the theory that we're talking about here, I would say that, as you also mentioned, a contract manufacturer by textbook definition would be manufacturing as per contract with the AE and would be making sales to the AE in usual course. So in those cases, we obviously, as you also know, we don't see instances of MNEs paying royalty on sales to the AE. So in such models, what we usually see is that the contract manufacturer gets compensated with a suitable markup on its total costs. However, in the kind of situation that you described, if the sales are being made to the Indian customers by manufacturing goods that incorporate technology, and I'm presuming also trademark intangibles received from the AE, then it is fairly common to see transaction of royalty taking place. Just like any other transaction involving intangibles, the question of whether royalty is payable in a given case will obviously depend on the assessment of whether and to what extent valuable intangibles, be it technology or trademark, have been provided, and thereafter we'll move on to the step of determining the arm's length price of the said intangible using the TP method that is chosen. The remuneration method that we commonly see is royalty linked to third-party sales. It is also now common to come across models that you described, where the taxpayers assert that the role of Indian entity is making those sales is so limited because the customers are pre-identified, perhaps, or there is a lot of involvement of AE in every aspect of the business, resulting in the role of Indian entity being so limited that they ought to be compensated with a routine return on sales and the residual profit. So in experience, what we see is we see claims of the extent to which they say residual should go out, either, you know, it's across a spectrum, I would say. Someone may say entire residual should go to the principal, someone should say a part of it, and then the question of how much part. So we see all sorts of permutations and combinations which are asserted to be awarded to the AE. So what I can assure you is that yes, the model you described is fairly common. We do come across it. I would say in APAs we have resolved cases of such models, and I would like to absolutely outrightly assure that the Indian Tax Administration is not averse at all to examining any of these models, of course on merit, and the outcome will ultimately depend upon the facts and circumstances of that particular case, as is so in every aspect of TP.
Thank you so much, Ms. Sharma. Pritam, what do you feel?
No, I think more or less all has been spoken by Ms. Sharma, but this is something similar to what mostly at least we were advising in this kind of structures. Like you said, how much residual should remain with India, how you establish that customer has been developed by the AE, what is the involvement, all those things have to be documented, have to be proved. So that is what is important in this kind of structure. Just by saying or entering into agreements will not help. So you come out with some sort of fact-finding exercise in that.
Thank you so much. Then I would maybe pose a last question now, before we come to the questions. A typical lack of transactions, actually, international transactions here charged from Germany to India, are management fees actually charged to the Indian subsidiary. For example, for human resource support, legal services, and so on, for the benefit of the Indian entity. Still, such management fees are picked up quite often in transfer pricing assessments. Now, what would you recommend actually the investor for meeting the expectations of the transfer pricing officer here to the CBDT?
So I'll answer this one as well. Whenever we see that the IGS transaction is picked up for audit, or if you bring it onwards in an APA as one of the covered transactions, so how we go about evaluating is that we would look at a number of things, and which the taxpayer can also keep in mind to ensure that the transaction is they're able to prove if they're pricing the transaction accurately, they're able to prove that efficiently. You know, what they can do is they can maintain robust and contemporary documentation which meets the benefits test. They should ensure that the payment that is made is commensurate to the services received. Indirect cost allocation, especially revenue-based cost allocation, is something that is always looked at closely, not just by the Indian tax administration, I believe everywhere, all across the world, wherever you have indirect cost allocations for IGS. We obviously try to examine whether payments made are for duplicative services or if shareholder services have been charged out. We also see whether group synergies are being claimed as intra-group services and whether payment is being made for, let's say, some kind of standard. Like those are something which is.
Ms. Sharma, can you repeat the last 20 seconds? If it was not only for me, then the audio was lost briefly only.
Of course, I'll do that. Of course, I'll do that. I'll make an estimate of what I said in the last 20 seconds. So what I was saying was indirect cost allocations is something we look into, followed by issues like whether.
I think Ms. Sharma, you're having some audio problems.
Yeah, I can see it on the screen.
Now you're back. Now you're back. Now you're back.
Okay. So duplicative services, shareholder services, examining whether group synergies are being claimed as intra-group services and whether payment is being made for, let's say, standby services, which the taxpayer has not availed for years on. Yes. So I would say that all the things I mentioned are actually very much there in, let's say, if we started out with talking about OECD TPG. So this is exactly what even the OECD TPG says in the chapter on intra-group services. So the same things are what we look at. And I would also say that it's not the case that intra-group services are specifically targeted for TP assessments as such. Whether a case involving intra-group services is picked up for scrutiny would again depend on objective determination through the risk assessment process, which has no human involvement per se. But yes, of course, if your case gets picked up for audit, or if you wish to cover your intra-group services payment transaction in an APA, then these are the things perhaps that a taxpayer can start looking into and plan the documentation in such a manner. And as the last point, I would like to say that again, I mean, we have done APAs where intra-group services was also the only covered transaction. We also have those cases in our APAs. So the tax administration does have the experience of sort of sitting together with you on a table and deciding the arm's length price of intra-group services.
Right. Thank you, Ms. Sharma. One follow-up question, which actually just came to my mind. Have you ever witnessed a situation where the tax office has alleged actually that the foreign, whatever, here management fee or royalty, for example, was undervalued in a sense that, as you know, there's a 10%, usually 10% TDS payable on royalties, management fees, and so on, fees for technical services. I think the audience will know that. Rarely, but we have actually seen that an argument was raised that more should have been charged, which obviously would reduce the profit in India, but on the other hand, increase the tax revenue from TDS, 10% taxation. Maybe as a follow-up question, just the last one. Have you seen that also? Or is this something actually where you're looking at?
I think the kind of adjustment you're referring to here was made not from the transfer pricing office. It was made from the International Taxation Office. So again, for those of you not familiar with the structure of the foreign tax work in India, it's done in two parts. So there's a transfer pricing vertical which focuses only on determining the ALP of the referred transaction. So that's transfer pricing, and then we have a vertical for international taxation, which would look at how treaties are interpreted by taxpayers and what kind of withholding is done by them, where it was, what kind of withholding taxes are being paid by them where it was necessary to do so. So I think the situation you described sounds to me more like it was in the latter category.
All right.
Go ahead, Dr. Patel. If I may just come in, I think Ruchika is right, because as per our law, the transfer pricing officer cannot reduce the income. And just, one more thing I thought I'd like to add on IGS is one small nuance of it, that what markup the AE is charging is also something which we look into. for the service that it is providing. So most of the, for example, Germany being part of the OECD has entered into low value services agreement and has a 5% markup for those services. So if an IGS is being or service is being provided for which there is a higher markup, besides the benefit test and all the things that Ruchika discussed about, we'll also look in whether the markup being charged is higher.
Okay, thank you so much. We do have received a question, right? Maya, would you want to, because we would now shift, also be open to take questions from the audience, either chat probably usually chat function.
Yes, I think if anyone has questions, then they can easily just post them in the chat. We have received one slightly longer question, which I have forwarded to one, if you'd like to.
I would maybe read it out because you're not so well audible.
Okay.
I read it out. It's indeed a bit longer. Now, a parent company sets up, I just read it. A parent company sets up global rate contract with many customers in India based on global volume of sales. Global rate contract with many customers in India based on global volume of sales. The rate differs from customer to customer in India. Parent company ships the goods to their entity in India, set up as a trading company, with the agreed uniform transfer price. Many times, global rate agreed with customers are less than the transfer price set up with the trading company. Parent company provides credit note based on actual billing to the customer in India from trading company. We expect taxation to be applied based on actual price offered to Indian customers by trading company in India, but not at the rate our parent company transfers to trading company in India. What is the guideline for taxation in this scenario? I think you read it in the chat box as well. I am having a bit of difficulties in understanding the case, but maybe you are better. Did you understand the question?
I mean, I'll just try to interpret it. Probably it's talking about purchasing finished goods and then distributing. Ruchika might come in if that's the summary which.
Yeah, I also, I mean, one thing I could take away was the fact that there is goods being imported and then resold. It talks about reselling, but it's not clear to me what they mean by prices being determined by the.
Yeah, I think what
maybe
asked here is that probably CUP or some other method which we used, to which I would just like to say here that we'll benchmark the entity rather than looking at individual prices here at what it is sold. So the entity as a whole should make a profit or return on a sale, which will be benchmarkable to a similarly placed entity. That a profit-based method will be used to probably benchmark.
I think I see the reason, maybe the question, the point behind the question. It's the German company has list prices with their global customers, and these prices are different from time to time. They're different. No? Through customer A, they sell at 100, to customer B at 90, to customer C at 80. Now they also have customers in India. And the customers in India are being sold to by the Indian trading company, Ms. Ruchika, as you said. Now, the Indian trading entity cannot go beyond what has been pre-agreed as a price. And therefore, actually, the Indian entity, the reseller may, I feel the question is sometimes even sell at a loss. Like the Indian entity, the Indian reseller has no other option but to accept the price which was agreed at the headquarter level. Not acceptable, actually, no? What do you think?
I think we can simplify this question by just looking at what is the TP issue here. What is the international transaction? Let's forget the third parties. The international transaction is that of purchase of finished goods by the Indian company. And usually, so then we're talking about a distributor, we can presume. So when we talk about a distributor, I guess it's, and presuming in this example doesn't sound like the Indian entity is trading with third parties. So perhaps it's a subsidiary distributor, not selling somebody else's goods, only the group's goods. And then in that case, I think, as Vijit did hint on in his previous intervention, he said that we would look at the characterization of the Indian entity, the functions of Indian entity as a trader. We would want to characterize it, whether it's a limited risk distributor, it has elements of any sort of entrepreneurship, even within limited risk, if it's really low risk, or what we are now referring to as, let's say, baseline in amount B work, for example. So we would want to understand as tax administrations, what is the function and role of the Indian company with respect to making these sales. We have seen cases where there's a global published price and you can't deviate too much from that. So that's again something which is there in many M&E's cases. So, but since it's a distributor, I think the key question would be to characterize the distributor, and then assuming it sounds like from the example that Indian side is the more simpler one in the transaction. So in that case, if we decide to choose Indian entity as the tested party, then of course we would look at the third party comparables and would try to find similar companies with similar profile and accordingly benchmark the transaction. And of course, if it is concluded that it's a limited low risk entity, then of course the arguments for a loss are not supported by the global guidelines as well. So I think that would approach.
Yeah. Right, Rushika. Just the maybe the good news would be for the company posing the question is that you would look at an average, no? Some at the end, no? Some sales may be at a loss, but some may be at a higher profit, and the average customs is different, no? But you would be looking at the average, right? At the average resale margin.
Of course, yeah. The case doesn't sound like we can apply a transactional pricing method, which is cup. Doesn't sound like we can do it, because there will be no cup. So then it would be an entry level, and of course it would average out. And of course, assuming that the group would also have such a policy in place, because when they have this kind of selling where it's mostly controlled by the M&E, then it's also common to see a very clearly laid out sort of pricing model for such subsidiaries, if not only the Indian one.
Thank you. Are there any further questions? It's your chance actually to talk to this CVTT directly. Go through the chat box. But if not, Maya, is that correct that we don't have any further question at the moment?
Yes, there are no further questions.
Right. Then actually we have also already reached our time limit, and okay, it was not sharp. I mean, if there's any additional question, I think we could still take it. But yeah, I found it very interesting actually to listen to the CVTT. Doesn't often happen to me too. It was great pleasure having you. And Pritam, thanks for joining too. And I think it is a really good example, isn't it, about or for how the Indian governmental organization, the tax office, and the Make in India Mittelstand program want to do handholding for you and with you for taking your fears and allowing investment into India with a positive attitude, no fear, and you can really expect to be treated fairly by the Indian tax office. In the rare cases we are not, we may help. But other than that, I think this is actually what the Make in India Mittelstand program is also for. As we said initially, it is for knowledge sharing, it is for taking your question, for providing a network, for giving initial support about various questions of law, financing, location services, technology cooperation, and so on. And this, I think, was a very vivid example of the same. And yeah, feel free to reach out to us when you want to become a member, of the Make in India Mittelstand program, or when you are a member with any questions you're having. And yeah, with that, actually, I would leave it for the day. I would call it a day. And I really thanks a lot to India Where are you based actually? Where is your office you're calling us from?
Both of us are in Delhi, New Delhi,
In
the
Delhi.
capital.
In Delhi.
Yeah.
Great.
And thank you so much for organizing this webinar. It was an absolute pleasure for us to join you all.
Thanks a lot for organizing this, and I hope it was informative for the taxpayers.
I'm sure of that.
Thank you.
Thank you so
everyone.
much. Have a good day. Thank you.
Thank you.
Bye.